Federal budget for 2026 has dropped, and most business owners are either ignoring the 300-page document because they are too busy, or they are panicking about the new tax changes they've heard about in the news. The reality is, if you make over $500,000 in profit, there are both massive opportunities and pitfalls to avoid in this budget, and you must act quickly for both. With over 35 years in business advisory, I've helped thousands of businesses in Australia save hundreds of millions of dollars in tax, structure for wealth, and build a large portfolio of assets outside of their businesses. In this video, I'm going to break down the 3 biggest changes that affect you as a business owner. The exact steps you need to take right now to protect your cash flow and your superannuation. Let's rip the band-aid off first. We are standing in a genuinely historic moment in Australian tax history. The last time we saw reform of this magnitude was with the introduction of the GST in the year 2000. If you're an investor or a business owner, you are definitely the biggest loser from this budget. And while the laws haven't received royal assent just yet, the direction from the government is clear. Do not wait for the ink to dry on these measures. We need to treat this as law for planning purposes right now. And here are the 3 biggest changes that affect you before 30th of June this year. The number 1 is the trust 30% taxation and the death of the bucket company. From July 2028, family trusts pay 30% minimum tax on all taxable income. But the kicker is for business owners that the bucket company strategy we've used for so many years is effectively dead. Corporate beneficiaries are excluded from the new tax credit system. In plain English, this means at the trust level, people will pay 30% tax, and at the income will then be distributed to a bucket company where it is obviously paid out as a dividend. But there is no credit flowing through to the bucket company. That is double taxation and is the first time in Australian history I've ever seen this. I've been working in the industry for over 35 years and have never thought that I would see that in this country. The good news is the government is giving us a 3-year rollover window from 2027 to 2030 to restructure out of discretionary trusts without triggering capital gains tax. But you will need formal market valuations to this, and we are still waiting to see if the state governments will waive stamp duty on these transactions and transfers. Number 2 is capital gains tax changes. From 1 July 2027, the famous 50% CGT discount is gone. It's being replaced by a cost-based indexation, so effectively CPI, and a minimum 30% taxation on capital gains, which a lot of people missed. Shockingly, these pre-capital gains tax 1985 assets that have been tax-free for 42 years, these are now falling into the taxation regime from 30 June 2027. If you are going to hold commercial land and property or business interests, this has a profound shift on the way you do business. To protect your existing gains, you must get a formal valuation on your assets as at the 1st of July 2027 to lock in that grandfathered 50% discount. Thankfully, the small business CGT concessions remain largely unchanged, although an announcement yesterday from the government has changed the threshold for turnover on one of those measures. Number 3, negative gearing changes. The classic Australian property investment strategy just got gutted. If you bought an established residential property after 7:30 on budget night, the 12th of May 2026, you can no longer offset losses from negative gearing against salary and business income. The losses are quarantined to property income only. If you bought a property budget night, or if you were buying a brand new build, you were fully grandfathered and protected. That is before budget night. However, these measures come in from budget night 7:30 p.m. and onwards. Now, when they're talking about grandfathering and quarantining these provisions, more specifically, those provisions mean that in the future you can carry forward those losses as a quarantined loss and offset them against future property income or capital gains when that property turns positively geared. However, you cannot claim that negative gearing loss against your business income or your salary and wage income. So that is the crux of the issue explained right there. The urgency and the action plan that you need to consider right now, and this is why I've stayed up till 2 a.m. on budget night and went through the detailed analysis, sent these to 2,000 of my best clients within the 6 hours after the budget. So people were aware that time is of the essence. You cannot sit on your hands on this, because when you think about it, property valuers and accountants have just made more than 3 years of work, and this has been dumped on their desks overnight. They've already got existing workloads of things that they do year in, year out. This is new work forced upon our industries by the government. There are millions of businesses and millions of property valuations that need to be done in the next 3 years. If you leave this till the last minute, you'll be stuck at a very, very, very long line, and it could be a very expensive queue. So you need to consider a plan A and a plan B, because your long-term restructuring is absolutely necessary if these measures are not changed. Now, I stress that these measures have not received royal assent yet. They are thought to go through relatively unchanged. And what I mean by that is that if you listen to the opposition's reply to the budget, they spoke about possibly repealing CGT changes if they get into power. They spoke about possibly repealing the negative gearing strategies that the government have brought in if they get into power. That's an if. And then if you listen to the rest of the budget reply from the opposition, they did not mention anything in regards to trusts and the 30% taxation of trusts. So my assumption from that is that this will go through with bipartisan support on the 30% trusts. And if that doesn't happen, that's a win for business owners, because the 30% trust issue is massive, and it will mean a dire situation for anyone who is left with assets and businesses in trust with the distributions flowing through to family members. And the reason I say that is that when those distributions come out of a trust, they are coming out with a 30% tax credit. Now, that's the equivalent of an individual person getting income with an average rate of 30%. Now, an average rate of 30% is over $200,000 worth of income. Now, not every Australian who is going to get a distribution from a trust will receive that distribution at an average rate of 30%. So the excess tax being paid is lost and goes into consolidated revenue for the government, meaning you're paying too much tax. Now, those 30% distributions, if sent to a bucket company, mean that the bucket company will not get a credit for the 30%, and they will in fact have that distribution with 30% tax paid on it, then pay a further 30% or 25% in the company, depending on what type of company is being distributed to. That means between 55 and 60% tax on that money that is going into a bucket company. Then, if the money comes out of a bucket company to an individual person, is then taxed at top-up rates, which could see another 20 to 30% of tax paid on that. So you could possibly see that income diminish to 10% of its original value if using a bucket company that then comes out to an individual. Absolutely disgraceful taxation of that type of income, and clearly the government does not approve of bucket companies. This means to you that the death of the bucket company is upon us. No more bucket company distributions after the 1st of July 2027. So to summarise, the bucket company is dead, CGT discount is gone, pre-1985 assets are captured, the negative gearing is restricted. If you are a business owner with meaningful wealth, especially if you're a property owner in a business hotspot like the Gold Coast in Queensland, which is ground zero for these reforms, you cannot put this in the too hard basket. The window is open right now, but windows close. So for meaningful advice for your specific situation, head over to the manageright.com.au website and book a consultation with me and my team. And we will build a plan around plan A, plan B, specific for your circumstances, depending upon what happens with this royal assent. Do not wait. Get your valuation sorted out early. Make sure your wealth is protected. Thank you so much for watching. I cannot emphasize enough how important these measures are. I'm going to go and grab a strong coffee and recover from my lack of sleep in recent weeks. Get on to your planning, and I look forward to seeing you on the next video.